the recession that will change a generation. Hey everyone! Today's hot topic in finance is the R word, recession. Post the 2008 Great Recession, the United States has largely steered clear of major economic downturns, except for the significant drop in March 2020, triggered by the unexpected pandemic. Since then, the U.S. economy has been on a remarkable run, with the S&P 500 yielding a total return of 357% since 2010. Those who invested during this period have witnessed their portfolios soar beyond expectations. However, recent shifts in the market are causing a stir, with even giants like JP Morgan expressing concern. Over the past 12 years, investors have enjoyed a relatively worry-free ride, with the market bouncing back quickly after each dip. This was especially true since 2010, when only 3 significant drawdowns exceeding 15% occurred in the S&P 500, and each time the market swiftly recovered to new highs. This history leads us to the question, why is there growing anxiety about a recession now, especially when the current downturn seems typical in terms of numbers? Historically, similar market dips have always been followed by quick recoveries. The answer lies in 2 critical factors. Firstly, in the past, the Federal Reserve has been our safety net, stepping in whenever the market falters. However, after years of monetary easing, especially post-March 2020, this safety net is no longer in place. The Fed faces severe inflation challenges, unseen since the early 80s, requiring them to raise interest rates and scale back their market support. Many analysts believe that we are entering an era where the market must fend for itself without the Federal Reserve's aid. This shift has triggered a massive sell-off in growth stocks. For instance, Zoom's value plummeted over 80% from its peak in October 2020. But when you look at the broader S&P 500, the extent of the crisis isn't immediately apparent. Despite numerous retail favorites dwindling to a fraction of their 2020 value, the S&P 500 is only down by about 14%. This discrepancy raises a question. If a market crash is indeed underway, why isn't it reflected more dramatically in the most important index? In 2008, for instance, we witnessed a roughly 50% decline. So what's propping up the markets this time? The key to understanding the current state of the market lies at its very apex, where companies like Apple sit like kings on a chessboard. Apple, in particular, is often viewed as the central piece holding the market together, especially in turbulent times. Despite Apple's stock being down by over 14% from its highest point, it plays a crucial role in keeping the market from spiraling downwards. Its performance is like a barometer for the health of the market at large. But here's where it gets interesting and a bit worrisome. Recent developments have cast a shadow of doubt over Apple's future performance. This isn't just about one company's profits and losses. If Apple's stock starts to tumble significantly, it could send shockwaves through the entire market. It's akin to pulling a crucial block out of a Jenga tower. The stability of the whole structure becomes uncertain. Apple's influence is significant because of its massive market capitalization and its role as a tech leader. As one of the most valuable companies in the world, its financial health and stock performance are closely watched indicators of broader market trends. A strong performance by Apple can instill confidence among investors, whereas trouble for Apple can signal potential trouble for the market. Moreover, Apple's global reach and diversified product line mean that its fortunes are tied to various sectors and regions. From consumer electronics to services and software, Apple's financial health is a composite picture of multiple market forces. Therefore, any significant change in Apple's trajectory could reflect or even influence these wider economic trends. Alright, let's dive a bit deeper into what's stirring up all this uncertainty in the market. You see, a big part of the problem is that corporate bigwigs aren't being as open as we'd like. Take Apple, for example. In their latest earnings report, they kind of sidestepped some really important questions about how consumer demand is changing. It's not just Apple, though. This kind of evasiveness is becoming more and more common among top companies. Why does this matter? Well, consumer behavior is like the weather vane of the economy. When people start changing what they buy, how much they spend, or even the way they spend, it sends ripples across the market. Companies need to adapt to these changes to stay afloat. If they don't, or if they're not honest about the challenges they're facing, it could spell trouble. So imagine this. You're driving, but your GPS isn't telling you about the roadblocks or traffic ahead. That's kind of what's happening with these companies. They're not giving us, the investors and market watchers, a clear picture of what's going on. This lack of transparency makes it hard for everyone to figure out where the market is heading. As consumers shift their spending, maybe they're tightening their belts, choosing different brands, or switching to online shopping. It starts to impact these companies' bottom lines. If these shifts are significant and the companies aren't upfront about them, the financial reports down the line could reveal some unpleasant surprises. And in a market that's already a bit jittery, surprises are the last thing we need. The bottom line is that the more open and transparent companies are about their challenges and how consumer demands are changing, the better everyone can prepare and react. If they keep playing their cards too close to their chest, it only adds to the uncertainty and anxiety in the market, potentially making any downturns even worse. And who's sounding the alarm? None other than the big guys at JP Morgan. Yep, one of the biggest names in banking is bracing for a recession. It's not like they're saying it's going to happen tomorrow, but they're pretty sure it's on the horizon. Michael Feroli, who's the chief U.S. economist over at JP Morgan, is one of those voicing concerns. He's like the guy who reads the economic weather report, and right now, he's predicting some rough seas ahead. Sure, the economy's been cruising along pretty well recently, but Feroli's pointing out that we might be heading into some choppy waters. He's talking about how financial conditions are tightening up. Think of it like the economy getting a bit squeezed. It's kind of like when you're driving smoothly on the highway, and suddenly you see those brake lights up ahead. You know you gotta slow down, but you're not sure how bad the traffic jam is going to be. Feroli's saying that with the way things are tightening up financially, we might be looking at a slowdown in the economy, and if we're not careful, that could lead us straight into a recession. So, what's causing this potential slowdown? Well, it's a mix of things. Interest rates are going up, which makes borrowing money more expensive. That means businesses might think twice about taking out loans for new projects, and people might hold off on buying houses or cars. All this can cool down the economy a bit too much, and before you know it, we're in recession territory. The thing about recessions is they don't just pop up out of nowhere. They build up over time, kind of like how pressure builds up in a volcano. And right now, JP Morgan's economists, like Feroli, are looking at all the signs and saying, hey, we might have a problem brewing here. So, they're not just guessing. They're seeing real signs that the economy could start slowing down, and that's why they're waving the red flag about a possible recession. The Federal Reserve's expected interest rate hikes are causing the dollar index to surge to record highs, impacting American companies' ability to compete in global markets. Higher interest rates are also expected to affect various financial sectors significantly. Already, mortgage rates have crossed 5%, and further increases could stall the housing market as affordability plummets. The fear of stagflation, a combination of inflation and recession, is looming over the market, a scenario where rising prices and high unemployment create a recipe for economic disaster. Michael Feroli further explains the market's reaction to the Federal Reserve's actions. The Fed's reluctance to raise rates by 75 basis points was interpreted as a lack of commitment to combating inflation, leading to market volatility. However, Feroli suggests that the Fed is determined to tighten financial conditions to slow down the economy's spending growth. The looming choice for the Fed is stark: either crash the economy to control inflation or let inflation run rampant. The ideal scenario of a soft landing is becoming increasingly unfeasible, placing the Fed in a challenging position to induce short-term economic pain to avoid long-term detriment. Thank you for watching. If you found this video insightful, please hit the like and subscribe buttons. Stay tuned for more updates on this evolving economic situation.